Welcome, everyone, and thank you for attending today's webinar. I'm David Shaw, the Publishing Director for Family Business Magazine. I hope that you and your family members are enjoying this summertime. The last year and a half has really caused a number of family businesses to examine their options. Do they buy other businesses in a hot M&A market? Do they sell? Do they rethink intergenerational transition? There's even the possibility of merging with a SPAC, a special purpose acquisition corporation, and going public. Any of these approaches and others have implications for the family. And this webinar is going to look at ways to blend personal and financial objectives, as well as tax considerations, into a comprehensive business plan to preserve family wealth. Before we get started, some housekeeping details. If you've attended our webinars in the past, you know how to ask questions, but if you haven't, right under the video screen, there's an Ask a Question area. Please do ask questions, throw in your comments. We'll get to as many of them as we can today. We will go for no more than 60 minutes today and get to as many questions and comments as we can. I'm really pleased to be joined today by Claudio Develis and Irene Estrada, both colleagues from PwC. Irene is a tax managing director who serves as a national resource to PwC's private company services practice, specializing in estate, gift, and trust issues for high net worth individuals. She advises clients on planning and compliance matters involving estate and gift tax, generation transfer tax, fiduciary income tax, and family business succession, as well as international estate and gift issues and pre-immigration tax planning. Claudio Develis is a tax partner in the personal financial services practice in PwC's New York City office. Claudio advises high net worth individuals, families, and business owners on all aspects of their income tax, estate, gift, and generation skipping transfer tax planning, structuring tax-efficient business succession plans, as well as counseling clients on the income, estate, and gift tax treatment of charitable giving. These two are both highly qualified to talk about some of the issues that'll come up today. And I welcome both of you. So with that, I'd like to turn it over to you, Irene, to introduce today's discussion.
Great. Thanks, David. Good afternoon, everyone. So today we'll be talking about, as David mentioned, transitioning a family enterprise and all the considerations that go into that. We have an agenda for today. We'll cover the business transaction from both the buyer's and the seller's perspective. Then we'll talk about various deferral techniques in light of the potential tax rate increases that it's been in the news. And then we'll finish with planning with various trusts for closely held businesses. So with that, let's start with the first item. When looking at a potential sale, what would be the considerations from each of the buyers and sellers' perspectives?
Thank you, Irene, and thank you, David, and for having us and for everyone in attendance. So this question, obviously, we get asked a lot, and we deal with it, frequently enough when clients are buying and selling businesses, and could spend the whole day just talking about this. I just want to touch, a few of the main points and the things that we have the most discussion around, and we'll start from the buyer's perspective. And this is in no particular, order of priority or importance, just, big ticket items like valuation. You're from the seller's perspective. So in terms of valuation, what are you selling for? Is it the right number? How did you get to it? Is there an industry, standard or specific? There are different valuation methodologies, and in certain industries you might have some multiple of earnings. You might have a multiple of top line revenue. You might have comparisons to other companies. At the end of the day, it tends to be industry specific, and from that point forward, entity specific. It becomes a negotiation. In terms of deal structure, there's a lot of different things to consider. Me, being a tax guy, I tend to get involved there the most. So, from a seller's point of view, look, long-term capital gains, right? It's a preferential rate versus ordinary income. And historically, that meant, you want to sell, stock versus, the business selling the assets. Today, you have, pass-through entities, whether they're corporations or LLCs, tax as partnerships. You can still, sell the assets of the entity and get capital gain, treatment for the owners. We are often looking at, are there specific items that might be, I'll use the term clawed back, because people think, I'm selling my business, I get long-term capital gain treatment. Not always, because you might be selling, as part of your sale, you might be selling inventory, accounts receivable, you might be selling an asset that's fully depreciated. In those instances, you have a portion of your proceeds, a portion of your gain is recaptured as ordinary income. It's not all capital gain, even though you're selling, what would be, capital gain assets. It's important to see what's going on. If you're not selling the full business, you might get rollover equity, and that gives you a deferral opportunity. A lot of discussions around how much you receive today versus the future. You might be receiving, some financing. Rather, that is, I'll sell 80%, or I'll sell the entire business, but I'm getting 80% today. I'm going to collect 20% over time. That could be as simple as a promissory note. It could be more complicated in terms of, an earnout, so that I think my company's worth 100, and you, Irene, as the buyer, think it's worth 100. So we agree on that price. But you said, I just want to make sure it's worth 100, Claudio. So I'm happy to give you 70 today, and I'll give you 30 over the next 4 or 5 years, depending on what the performance is. So I essentially have to earn out the rest of my money, and that could be complicated, right? Because I'm in control of the business today. You buy it, you're in control of the business. So if the earnout is based on what the earnings of the business are, I'm no longer in control of what those earnings are, and you might load up with certain expenses. You might say, well, I needed to go out and hire 3 other people to do, what you did. And, that impacts the bottom line. So, we don't make as much money as you said we made. So sometimes you negotiate, like, what goes into the determination of what the real earnings are. You quote, like, normalize, those earnings. And that's impactful for valuation also, because someone might say, hey, you only make $20 a year. No, I really make 80. On for tax purposes, I make 20, because we might be charging rent to my personal entity, which we've overstated for various reasons. Maybe we're paying the children more salaries than we could get out in the open market. So you kind of like normalize those things, so that when you're talking about a real earnout and how someone is performing, you get to a point where it's like, look, we think our income is around $10 a year. So if you've done something to drop it down to 4 so that I don't get my earnout, that's not going to work for us. The recommendation is always get as much money as you can, today, versus the future, unless it's just a promissory note and it's not tied to specific, performance. Because, think about someone who might have sold their business in 2019 or 18. Look what happened in terms of the pandemic. I can't imagine how many issues there might be out there from the buyer's perspective. I've sold my business to you, the pandemic hits, you owe me money on the back end. There's probably a lot of negotiation that's going on. And even in terms of just that financing, right? I'm going to sell 70% now, 30% later on. Okay, well, you've essentially sold your business as the seller on an installment basis. Maybe that's good. Maybe that's the deal you came to. But at the end of the day, for income tax purposes, you have an installment sale. And you pay tax on an installment basis, which means you calculate your gain and you pay the tax as the cash is received for what you've sold. There's usually a lump sum upfront, makes sense, and you'll pay tax in that year. As you get future installments, the tax is paid in those later years, which means you're taking some risk from an economic point of view, but you're also taking a risk from a tax point of view, right? Because if you sold your business in 2020 and you're receiving installments in 2022, there's a good chance next year tax rates will be higher. So you sold the same business, you're just collecting your money, your accounts receivable, but it's subject to a higher tax because of this installment treatment. Well, installment treatment is the standard. It's the default method. You can actually opt out of that, if you want to. So when a client says, do I want to opt out of, installment sale treatment? That means I have to pay all the tax today, and I'm not going to get all of this money for the next 2 or 3 years. Like, what are the considerations for that decision? Well, one is you think capital gains might go up in the future, so you'd rather pay tax today on money you haven't fully received, and then when you receive the back end of the payments, you don't have a taxable event because you've already paid the tax up front. If you do that though, you run the risk that you don't get a payment on the back end and you've paid the tax up front, and then there's adjustment provisions to take that into consideration. But you're prepaying a tax you didn't have to pay. If you stayed in installment sale treatment and your back-end payments are greater than $5 million, there's a deferred interest charge that the government, charges you, because they're saying, well, hey, we'll let you pay the tax in installments just like the money you're receiving, but we're going to charge you for that. So that's an additional transaction cost. And I remind everybody on these earnouts, so in my, Irene, you're giving me 70 down, 30 over time, and there's no interest. There's no such thing as an interest-free loan in terms of the IRS. So when you make those payments to me, there will be imputed interest income. It's original issue discount. So for someone thinks, oh, I have $30 of capital gain on the back end, some portion of that 30 does get recast as ordinary, income. As interest expense. And the last big thing I want to talk about is, has nothing to do with tax. It's what are you going to do after you sell, right? We have business owners who've been in business for 40 years, 50 years, or the family, multi-generational, 80, 100 years. A lot of their lives is centered around, this business. Sometimes it just becomes the identity of the family. If you're out of that business, what are you going to do? Do you have philanthropic, interests? Do you have, other interests that you might want to pursue? The family business sometimes becomes the pseudo family office. Like the accounting department takes care of things for the family. That's gone. The business is gone. Do you form a family office? Do you join a family office? All things to work through, because you are going to have a major lifestyle change. From the point of view of the buyer, the first topic I want to hit is valuation, because it's the same thing that the seller had, except it's in the reverse. So did we get the number right? Maybe we should have an earnout to hedge against, oh my God, we've potentially overpaid for this. From the seller's, from the buyer's perspective, we're buying your business, Irene. Like you are the business. You're the face of the business. Maybe we should keep you on 3 years, consulting arrangements. Try to help facilitate the transition. Maybe you help us bringing over the key clients or customers of that business. What about key employees? You might have a management team in place that we want to retain. Those people might have loyalty, to you, the original family that they've worked with for many years. A lot of them will still likely need jobs. We want to retain them. We've had conversations regarding structuring, whether it's, like phantom equity. It's like, we want you to stay. We don't want you to leave, but we will incentivize you to stay, whether it's, future appreciation, we'll guarantee you some sort of phantom equity, in your retirement, or if we subsequently sell the business. And then just, tax in general. You're the buyer, you're spending a lot of money to buy the business. How do we get the most bang for our buck? We want to take depreciation deductions, amortization deductions. And lastly, in the purchase, is there a possibility of tying estate planning into the purchase, right? I'm going to buy your company for $100. Maybe I've already done some estate planning. Maybe there's a trust for kids that's got $10 million in it. Maybe it can participate and become a purchaser for 5-10%, whatever it may be. It's a good opportunity at that time to tie in some of these other family entities. And we've had this conversation a million times in terms of estate planning strategies, which I'll just punt it back to you. What are the type of things you're seeing in terms of the last few years with estate planning? I'm talking about tying it into a purchase, but it could be that, or just in general. There's been a lot of noise in the system with estate tax changes.
Yes, yeah, no, definitely, Claudio, and thanks. That was a great overview of considerations if you're selling to a third party. But as you mentioned, you could be wanting to transition to your family, and what kind of estate planning strategies would you want to incorporate in that situation? I think I would first talk about what you mentioned, the noise with the potential changes. There were several legislative proposals released earlier in the year. We had Senator Warren's wealth tax proposal, had Senator Sanders' proposal, which covered a wide variety of estate planning strategies or targeted them, including reducing the estate and gift exemption, making changes to GRATs, Grantor Retained Annuity Trusts, which I'll talk a little bit more about, changes to how defective grantor trusts are treated, valuation discounts, GST dynasty trusts. So there were a lot of things incorporated in Senator Sanders' bill. And then we had two very interesting tax proposals get released from the House and the Senate related to the step-up in basis, current step-up in basis rule, and really making changes to how that applies, and really getting rid of that benefit that we currently have for taxpayers. So taxing unrealized gain upon gift or at death in certain situations, and even a sort of mark-to-market rule for trusts. So those are some of the proposals that were floating out there early before the administration really had a chance to weigh in on what its priorities were. We were curious to find out what they would focus on. I think we were expecting, at the very least, that the estate exemption would be reduced, the estate and gift exemption. There was a lot of talk of that. But then the administration released their proposals at the end of April, and they followed it up with the Green Book, which went into some more detail about on their proposals. And a little bit to our surprise, there was no mention of reducing the estate and gift exemption, at least in the near short term. Under the current law, if no changes are made, the exemption will drop by about half after 2025. So it's already built in that there will be a reduction in the future unless that's changed. But we were expecting it to be accelerated. And at least at this point, it's not clear that's going to happen this year or next year, although they still need to actually negotiate the bill. And so we'll see what happens when we get a draft of the bill and whether that will make its way back into the discussion. But all of that is a way of saying that, we have clients who are engaging in estate planning now or planning to in the future. And there's been a lot of questions of what do we do? How do we plan for these changes that could or could not happen? There's a lot of uncertainty out there, and it is a little bit difficult to plan with so much uncertainty. I would say with respect to timing, if you do want to use up your exemption amount, even though it's not looking now like it's in an immediate danger that it would be reduced, by the end of this year, which is what we initially thought, I still would go ahead and plan to get it done this year because we don't know what next year will bring. We don't know what the tax changes might be, but we feel fairly confident that we know what the rules are this year. There was some concern about retroactivity, potential retroactivity. But at least in the Green Book, it does appear that aside from capital gains tax, that all of the other proposed changes would be prospective. The effective date would be prospective. So January 1st, 2022, which at least is good. It would give people some time to plan once we know what actual changes will be implemented. So, so the good news is it looks like we know what the rules are this year. If you did want to engage in some estate planning, either creating a defective grantor trust or a GRAT, or substituting assets out of an existing trust, selling to an existing trust, distributing from an existing trust, you might want to consider doing that this year when we know what the consequences would be, as opposed to waiting till next year where it could be a little bit less certain of what potential tax changes would result from those transactions. So I'll stop and give a little bit of an overview of both GRATs and defective grantor trust. For those of you who are not familiar, these are two popular techniques. They're both known as estate freezing techniques because they freeze the value of your current estate and then they shift appreciation down to later generations. And so basically a GRAT, a grantor retained annuity trust, is a trust that you put assets into the trust, and then a lot of people zero the trust out, or it's called zeroing out the GRAT. And what that means is you take back an annuity that is equal to the amount of money that you put into the GRAT. So you put in 1 million, you're going to take back 1 million over the term of the GRAT, including an expected rate of return, which is known as the 75/20 rate. Right now, the interest rates are historically low, so it's a pretty low bar that you have to meet and exceed to get any appreciation over that passed on to later generations. The nice thing about a GRAT is that if you're successful, that additional appreciation passes on to your beneficiaries free of gift tax. GRATs are generally set up as short-term, so 2-year GRATs. You could definitely set it up for a longer term, especially with interest rates being so low. Maybe you want to lock that in for a longer period of time. The reason most people do short-term GRATs is that GRATs are really great for volatile assets. So assets that, could move up and down very quickly. And so if the asset does happen to move down in the first year that you set up the GRAT and you do a 2-year GRAT, then you get the asset back at the end of 2 years and you can try again and you can try to catch it on the upswing. Whereas if you set up, say, a 10-year GRAT, a longer term GRAT, and you have the misfortune of having the asset go down in the first year, the asset's tied up for the next 10 years, you can't really, try again. And even if there's appreciation later in the GRAT, it may not make up that initial downfall. So that's why people often do 2-year GRATs and even rolling GRATs, where you keep setting up new 2-year GRATs and you keep rolling it over and trying to capture the upside and pass that on. The defective grantor trust is similar in that you're trying to get appreciation out of your estate. So the way the defective grantor trust works is you generally need to seed the trust. So put in 10% of what you would like to eventually put into the trust through a gift. And then you would sell the remaining assets to the trust for a promissory note. So the nice thing about the defective grantor trust is that even though you're putting assets into the trust, you are getting the promissory note payments back. So you're not losing that cash flow per se. But any appreciation over the promissory note, which would have an interest rate based on the current AFR, applicable federal rate, would again pass on to your beneficiaries. Now, as I mentioned, a GRAT and a defective grantor trust, they're very similar in many ways. They're both ways to freeze your estate and pass appreciation down to the next generation. But they do have very different tax considerations. So depending on your actual facts and circumstances, one may be more relevant to you than another. So a GRAT typically is not a great vehicle if you want to apply generation skipping transfer tax exemption, known as the GST exemption. That's the exemption that you have to shield assets from generating a tax if you pass it down to, say, a grandchild or a generation 2 below you. So GRATs are not effective, or not generally effective for that, because you can't apply your GST exemption on the front end. You have to wait till the GRAT terminates and you know how much it's appreciated, over the 75/20 rate. And at that point, you apply your GST exemption, but then you've lost the leveraging that you normally get. Whereas with the defective grantor trust, you can allocate your GST exemption on the front end, and then any appreciation that occurs down the road is fully covered. And so to the extent you want to do GST planning, you may prefer one vehicle over the other. But that's a brief overview. There's definitely a lot of other things that go into, both trusts. So the details are where it gets complicated, because you definitely have to think about cash flow, when satisfying the payments for GRAT. If you're putting in an asset that's hard to value, you have to consider getting valuations each time when you're using the hard to value asset to satisfy the annuity payment, if you're going to do that. They're both grantor trusts, which means that the grantor is paying the income tax on the assets that are inside the trust, which is really a great benefit from a tax perspective, because these assets are out of your estate, presumably the appreciation is out of your estate, and yet you're paying the income tax on those that the assets are generating. So it's a nice way to almost make gift tax-free transfers into the trust, because you're paying the income tax on those assets. It does make them good vehicles for S corporations, because a grantor trust is one of the eligible shareholders. So it is something that you could use an S corporation interest in, but again, considering the cash flow. I think in addition to those planning techniques, which as I mentioned are the two most popular, for those of our clients who are inclined to philanthropy, the two most popular trusts, charitable split interest trusts that I see, are charitable remainder trust and charitable lead trust. And so starting with the charitable lead trust, that's a trust that's can be very effective, because you can zero it out much like you can zero out a GRAT. And what that means is you can transfer a lot of money to a charitable lead trust and have no gift tax ramifications, even though the remainder of the trust would pass on to non-charitable beneficiaries. Unlike a GRAT, a charitable lead trust is generally longer term. I mean, the longer the better, because you really see the leveraging. If you have like a 20-year CLAT, although you might not be able to set it up for that long, but the longer you can make it, the better. If you set up as a non-grantor CLAT, you don't have to worry so much about predeceasing the term of the trust, which is the case if you set up a grantor CLAT. You might have to, the term is one that you think you'll survive, just because there's some very onerous recapture rules with the charitable deduction if you die before the term of the CLAT. Again, CLATs are, they're powerful vehicles, but they are complicated. So I don't want to spend a ton of time talking about them, because as Claudia mentioned, you could talk all day about the business transactions. Is the same with charitable split interest trust. But I guess I'll just mention briefly on the charitable remainder trust. It's the reverse of the charitable lead trust. It's the trust that you set up and you actually retain an annuity interest or a unit trust interest for yourself or your spouse during your lifetime. I mean, you can set it up for someone else, but most commonly you retain it for yourself or a spouse, and then the remainder goes to charity. And the reason you would set that up is to get the deferral, because a charitable remainder trust is a tax-exempt vehicle. So you can put appreciated assets into that trust and then sell those assets, and the gain that's generated on those sales is trapped inside the trust. And until those distributions are made out to the grantor, it doesn't carry out that capital gains. And so it defers the taxation, which is going to be very beneficial if some of these tax proposals get through and things like the capital gains rate get increased. But Claudia, maybe I'll turn it back to you on what other potential deferral strategies shareholders of closely held private companies should be thinking about with some of the proposed tax changes. or David?
Just before that, Irene, a question that was relevant to what you just talked about. Can you touch at all on the proposed King-Grassley legislation for private foundations and DAFs? Because when you're talking about remainder trusts and so on, many clients tend to establish large or such vehicles right after a big liquidity event. Do you have any comment on that? How a family could prepare around that?
No, that's a good question, and I know that that did come out. I must confess, we have a tax exempt group that deals more with private foundations and donor advised funds, and so I know they have been all over that and are planning to have a write up about those tax changes. So I haven't been keeping close touch on that. I don't know, Claudio, have you reviewed that?
No, I was waiting for Laura to send me.
We're waiting for the Cliff Notes version
Fair
of the bill.
All right, over to you, Claudia.
Yeah. So, in terms of, deferral strategies, especially if someone, is really thinking about, when you're a seller, you're going to sell your business, maybe you'll have capital gains. That capital gain could be from the sale of stock. It could be, passed through to you from your interest in an LLC or some partnership. So the last few years, there's been a lot of conversation around, qualified opportunity zones. So you have the ability, starting, from 2018 was the first year, to roll over your gain into a qualified opportunity zone fund. So I sell an asset, I have $100 gain. I could take $100 and invest it into a qualified opportunity zone fund, which will essentially permit me to just not pay tax on that $100 until some future date. That future date is 2026. Any gain that you roll over into an opportunity zone fund is essentially deferred and deemed recognized December 31st, 2026. So the tax will be due for the 2026 tax year, let's say in April of 2027. There are some benefits the earlier you make these rollovers, because you can essentially, if you did it up front in 18 and 19, you essentially get a reduction in that capital gain that you rolled over of 15%. You still have an opportunity for this year, as long as you in the opportunity zone for 5 years, you could essentially reduce that capital gain that you rolled over by 10%. So in my example, I got a $100 gain that I rolled over this year into a qualified opportunity zone. I will ultimately pay tax or recognize that gain in 2026, but only on 90, not the full 100. In addition, if you remain invested in the opportunity zone for 10 years or more, the investment, the appreciation above your initial investment. So in my example, I rolled over $100. Everything above that $100, the future gain is exempt from tax, whatever it grows to. So that's a pretty powerful tool. And we were having a lot of conversations about that in 2018 and 19. It kind of slowed down after that. It seems to be picking up again. A lot of the decisions were not so much about the tax benefits, but the real economics, right? Because I'm going to take my gain, I'm going to roll it over. If the opportunity zone fund does not perform, right, my $100 investment in my example decreases in value to $65. On December 31st, 2026, I'm deemed to have recognized $100 of gain. So a lot of clients were more concerned about the actual economics, not the tax result, because the tax result is very good, and that tax deferral qualified for whether it was long-term, or short-term gains. So this is something that has been a hot topic for the last few years. We have clients when they're structuring investments and then they're on the, if you're on the buy side, for instance, if you're buying a business, and that business is a C corporation, not a partnership, something like that, you potentially can make sure that your investment qualifies as a QSBS, Qualified Small Business Stock. If you meet the criteria, which there are a bunch of them, I'm not going to go through, you essentially could get, $50 million, exclusion in capital gains in the future. It could actually be even more depending on how you structure it, how things are layered to excuse me, it's a $10 million, but you could multiply that by structuring it the right way to get capital gain exclusions, additional exclusions. And lastly, we have conversations with clients who are selling, maybe rollover equity, right? Irene is going to buy my business. Maybe she buys 60% of it. I hold on to 40, or we sell and, reinvest in a new entity in which I will get a piece of that, maybe 25%. Or if there's a strategic buyer that comes along, a Fortune 500 company that's going to give me stock in their entity. So I'm a seller, but I essentially get rollover equity. And to the extent I get rollover equity, it is possible to structure that so that I'm not paying tax on the full sale. That is the portion of my rollover equity is not currently taxed, and it will be taxed at some point in the future. Those are the most common things we've been talking about lately in terms of deferral strategies for someone selling the business.
Thanks, Claudia. So it's great to think about potential deferral strategies. I guess on the other end, for clients who are looking to potentially accelerate gains, they're thinking the tax rate could go up, capital gains rate could go up. I mean, maybe not to the ordinary income tax rate, although that's possible. But if the client is planning on selling their company later this year or even next year, and they want to get ahead of any potential increase in the rate, what are some techniques that they could consider to accelerate that gain?
So for everyone's benefit, I will tell you personally, this has been the hottest topic the last 2 months. Biden proposals, what's going to happen with capital gains, what should I do now? I mean, I have 2 of these calls, a day. And internally, and Irene and I had worked on this, we kind of came up with, okay, well, what could we be telling clients? What should we be advising them? There's like a whole host of different strategies. They're not all applicable to everyone. But in terms of just getting ahead, of the client conversations, I go through a list of things that we talk about all the time. In the first instance, start with the simplest. If someone is just concerned about increases in capital gains rates, right now, capital gains rate is 20%. The Biden administration has talked about, bringing that up to ordinary rates, meaning next year it could be 40%, and that's for anyone, making a certain level, of income. The likelihood of that happening is low. But there's a good chance that gains rates do increase to 25, or 28%, which seems to be the revenue maximizing rate in terms of like, how much can you increase the tax before you start losing money because people just don't engage in transactions. So if somebody wanted to plan for, this rate increase of 5 or 8%, what can you do, if you really wanted to lock in the 20% rate, for this year? Well, if you got marketable securities with, big built-in gains, you could just sell them and then buy them back the next day. So, I hold Microsoft at $100 with the $10 basis. I sell it. I recognize my $90 gain, but I like Microsoft. The next day I go out and buy the Microsoft again. I use the same money that I just got from the proceeds to repurchase the stock. So I'm invested in Microsoft at 100. I just stepped up my basis now. And I have, $90 of capital gain, which I know I'm going to pay tax at 2021 capital gains rates right now, 20%. If you don't have marketable securities, which are the easiest to dispose of, what do you do with closely held assets, like, interest in a business, S corp, partnership, whatever it might be? Well, you could sell them to a non-grantor trust that kind of keeps the asset, in the family. So a non-grantor trust is separate and apart from me, the seller. It's a standalone taxpayer. It's as if I'm selling to a third party. So I sell my asset to the trust. The trust needs to have cash to pay me for that asset, or it could issue a note, and there are, concerns around that. Is it real debt for tax purposes? But assuming you structure the transaction properly, you have a taxable event. I've sold the asset, but it stays in the family. For clients who might have an S corporation, you can distribute an asset from an S corporation to a shareholder. That, for tax purposes, when the S corp distributes an appreciated asset, that's as if it sold the asset for cash and distributed the cash. So a highly appreciated asset from an S corporation that's distributed to a shareholder is a deemed sale. So the shareholder winds up with the asset, and the corporation recognizes the gain and pushes out that gain to all of the taxpayers. So you can do that before the rate goes up. If you have assets in a non-grantor trust, you can distribute the asset, very similar to the S-Corp strategy. You distribute the asset to a beneficiary. Under the general rules, a distribution of an appreciated asset from a trust to a beneficiary is not a taxable event at all. But the trustee of the trust can actually make an election to say, we know it's not taxable, but we'd like to elect taxation here. So now I'm going to distribute to Irene, the beneficiary of a trust, a asset that's worth $100 with a $10 basis. And I make the election. That event, then that distribution to Irene triggers the $90 gain. And Irene will pick up that capital gain on her personal return, and she gets the asset, for $100. If anybody is a seller, and maybe you've sold a portion of your business on the installment method that I talked about earlier, maybe there's a note hanging out there, because in Irene's case, she said, Claudia, I'll tell you this, $100 asset, I'll give you $70 today for your business and $30, over time. I have an installment sale. And if I didn't opt out of installment sale treatment, I have this account receivable that I'm going to pay tax, on the capital gain as Irene makes, payments on that note to me. So my hands are kind of tied, but I can actually trigger the gain today on Irene's note, even though I didn't opt out of installment sale treatment, let's say 2 years ago, when I entered into the transaction. I can gift that note to, let's say, my children, a trust for my children. I could pledge the note as collateral with a bank and have them give me, a loan against it. Those events will automatically trigger the gain on that installment sale. For someone, I mentioned opportunity zone. Maybe someone rolled over a gain into an opportunity zone, and they said, "Yeah, Claudio told us that we don't have to pay the tax on this until 2026, but we think capital gains rates are going to be higher in 2026, and now I can't, get out of this thing." Well, I guess you could always sell your, opportunity zone investment if you want, or you could just gift it. You could gift it to a spouse in a non-gift transaction, but that's a trigger, meaning the gain that you rolled over will automatically be triggered now. So it's no longer tax-free. There are some partnership strategies also for contributions to partnerships. I won't get into all of the details. It's very complicated, but ultimately, when I have an appreciated asset, so Irene and I are going to start our own accounting firm to compete with PwC, and Irene, she's a big shot. She says, I'll put up $50,000 of cash, and I'll say, oh boy, I don't have $50,000. I got $50,000 worth of office equipment. Let me contribute that. And my basis in this office equipment is like $10 or something like that. When I contribute appreciated property to a partnership, that's not a taxable event because it's specifically exempted from the code. It is possible to structure the contribution to a partnership in a way where you trigger, you have to fail certain investment partnership rules. And in family limited partnerships, which we use for estate planning purposes, these issues come up all the time, right? Because you're contributing cash, and maybe you're contributed a book of marketable securities. Everyone thinks, well, I'm just putting it into the partnership. It's no big deal. I'm going to do this for estate planning purposes. But you can actually engineer that in a way that your contribution of those marketable securities it is a taxable event. So you still own the marketable securities. You've just triggered the tax. And lastly, I will say, as we're talking about all of these strategies and people say, oh, this is great. I have a few different options. We got to work through the nuances and the difficulties. Remember this, unless you're selling the asset and just taking the cash, like I've talked about a bunch of strategies in which you keep the asset and just trigger the gain. You have a dry tax charge, meaning you've triggered the gain and now you owe tax. But you don't have the cash. You still own the asset on which you've triggered the gain. So you got to come out of pocket, somewhere else. That presents an opportunity cost, right? If I was going to sell the asset in 5 years, but I said, nah, I'll just trigger this gain today. That means I have to come out of pocket the tax dollars today. That means those tax dollars are not otherwise invested. And that's an economic decision that needs to be made. And I don't want to estimate that and have people think, yeah, there's all these wonderful gain triggering, strategies to lock in the lower rate. These things would be great if you thought, I'm going to sell this asset within 6 to 9 months. Okay, my tax on my, phantom transaction here that triggers the gain is due next April. If I'm going to sell the asset in March, fine, I'll have the tax anyway. So I might as well just sell it today. But if you're not selling for 5 years, you need to think about the consequences of selling that. So.
Yeah, Claudia, that's a good point. And I think one other thing I would like to mention is, we're talking about these acceleration opportunities as if the effective date for any capital gains rate increase in the future. But the Green Book did actually put the effective date. I made a quick reference to this earlier, but I didn't go into detail. They did put the effective date for the capital gains rate increase as April 28th. I mean, that date is not actually in the Green Book. It says date of announcement, but from all accounts, that means April 28th, the date that President Biden gave his speech on this American Families Plan. So although no one expects that date to stick, I mean, it would be highly unusual to tie an effective date with basically, a speech, because there is no bill. They have in the past tied the effective date of a capital gains rate increase to the introduction date of the bill itself. When an actual bill is introduced, they say the effective date for the capital gains rate increase is today. And you can understand why they would do that. They wouldn't put it in the future. They're worried about people rushing out and selling assets and then, potentially affecting the stock market. So they don't want to put a date. That being said, to put a date in the past, because the Green Book came out at the end of May, and then they put the date April 28th, it would be very unusual. So we don't think that's going to stick. But I don't want people to be surprised or not understand that there is a risk that any transactions you enter into now could potentially be caught if they do stick with the April 28th date or some other date in the past. But I think most people do think it'll be date of introduction of the bill, which we're expecting to be this fall. But we won't know that until we see the bill, we see what the effective date is in there.
Yeah, that's important to note, because if people think, well, let me just get this done, over the summer, there is nothing that says Congress cannot say the change in the capital gains rate is, even if it's not April 28th, it's July 1st. And it's like, oh, I did my transaction on July 10th. I thought I was, following PwC's lead here and locking in the lower rate, and it turns out, not to be the case. So there's no guarantee. And in addition, maybe you can talk about it, Irene. If anyone wants to enter into these gain acceleration strategies, maybe you just talk about how does that impact any existing planning, estate planning that was done in the past, trust structures that are already in existence?
Sure. So you may have business interests that are already held in some of these trusts that we discussed, a defective grantor trust or a GRAT or something, and especially if you're entering into a third-party transaction. So you're selling to someone outside of the family. So a bona fide sale, but you don't own the entire asset. You've already done some of the planning we discussed, and now 50% of the business is owned by these trusts that are outside of your state, and 50% is owned by you. But as I mentioned earlier, a lot of times these trusts are set up as grantor trusts, which means that from an income tax perspective, you almost ignore the trust as a separate entity. It's you effectively. You pay the income tax on those assets. And so the same would happen for a sale. If you were to sell 100% of your business and 50% is owned in the trust and 50% is owned by you, 100% of the gain, assuming it's a grantor trust, would be taxed to you. Now, that's a great answer from an estate and gift tax standpoint, because, there's this huge gain going to the trust. You're paying the tax on it. The trust has all of the assets. It has no reduction for taxes, and it's all out of your estate. From an estate planning standpoint, we love that. From the client standpoint, maybe not always the best news, because they may have liquidity or cash flow issues. They may not love the fact that they're paying 20% or higher capital gains rate on assets that are out of their estate, so they don't have access to those assets. So it may be the kind of thing that, even though you liked the idea of a grantor trust, you would maybe not like the idea so much if there's going to be a huge capital gains bill that you have to pay. So in that situation, you may want to consider, if you're engaging in a sale and you have the situation, turning off the grantor trust power. To turn off the grantor trust power, it's also known as toggling. There's usually a way to do that. Trusts are generally drafted so that the grantor trust power can be turned off. It may be more complicated depending on if the spouse is a beneficiary or not, but there's generally ways to turn it off. So that would be something you'd want to consider before engaging in a sale where a trust owns part of the interest. If you do decide to turn it off, I would not recommend turning it back on right after the sale. It starts to look abusive if you're toggling on and off, especially in a very short time frame or around a big event. So generally we say, if you're going to toggle on or off, plan for that to be somewhat of a permanent change. Now, there can always be changes in circumstances, and 10, 15 years down the road, maybe something's happened where you really want to switch it back on or off. If enough time has passed and you can really make a reason for why this makes sense, I think that's okay. But I think turning it off for the sale and then turning it back on right after the sale might be a bit, it just would raise some questions potentially from the IRS. So that's on the income tax side. On the gift and estate tax side, I think the main thing to keep in mind is that even though we're ignoring the trust from an income tax perspective, we're like, oh, that's the grantor from an income tax perspective, we really do need to respect it from kind of a valuation standpoint. So if the trust owns 50% of your business and you sell the trust or sell the business, 50% of the proceeds needs to go to the trust. Now, that may seem, obvious, but it might be less obvious in a restructuring situation. So let's say you're restructuring a business that is partly held in a grantor trust, effective grantor trust, and you're saying, well, I'm restructuring. I'm not transferring anything into the trust. How could there potentially be a gift or, other transfer? If you're restructuring the business in a way that shifts the value, either into the trust or out of the trust, that could be an issue. There is an ordinary course of business exception. So if you can prove this is something that, is in the ordinary course of business, it'd be something that a business would do without family members, then you might not need to worry about any shift in value. But if that's not the case, and IRS is just always going to scrutinize transactions involving family members because, they're worried about these shifts that are happening kind of below the like it's disguised as a restructuring. You just need to be aware of that. And I would say that you need to be worried about it both ways. So people generally think, oh, well, as long as the value is not shifting to the trust, I'm okay. Because if it's shifting to the trust, that's a gift. We all understand that. But if it's shifting the other direction, who cares? That's not actually the case, because if it's shifting the other direction to the grantor, that's a benefit that the grantor is getting from the trust, and that's a Section 2036A1 issue. So that actually could be worse, because that could taint the trust and pull that trust back into your estate. So you really need to be careful about shifting value in a restructuring.
And Irene, just one last point, because you talked about like grantor trusts. Depending on what happens with the Biden administration and the tax reconciliation bill later in the year, this might be like your last opportunity to deal with a grantor trust, right? So if you had an asset in the trust that you thought, maybe based on new tax law, I don't want that in the trust, or vice versa. I have an asset that's not in the trust. You still have an opportunity before the end of the year potentially to swap assets, right? So I have Microsoft stock in the trust, and another closely held business interest or some other asset that, if you can prove the values are the same, and that might require an appraisal, you can swap those out. So I'm going to take a dead asset, take it out of the trust, put a hot asset in there, or vice versa, just in response to tax law. And that won't be an income taxable event if values are the same. There's none of this shifting that Irene was talking about. This might be the last year to do that.
Yes. Yeah. I mean, we didn't go into great detail about the step up in basis potential changes, but a significant one is that it would take a lot of things that we kind of take for granted now that we can do with grantor trust because of the disregarded nature of them for income tax purposes. So we can swap assets in and out. We can sell to the trust. We can gift to the trust. The law on the step up in basis could potentially make all of those transactions taxable and trigger gain if you're shifting appreciated assets. So it's a good point, Claudio. I mean, that's another proposal that I think most people think is not likely to pass, but we'll see. No one can really predict what Congress will do, and we'll have to see when they start negotiating this fall if it does have some legs, and if it does, the effective date in the Green Book is January 1st, 2022. So that gives you some time to do it, but maybe not a lot. It's already June.
Yeah, great.
Terrific. Well, I've got a couple of questions here. We only have 3 minutes left, but let's see if we can at least get to one of these. Can you help with taxes if in a transaction, if you sell to an ESOP without taking the cash up front? Does that give some kind of tax benefit to a selling business?
I mean, there's definitely benefits, right, of selling to an ESOP, or at least a C Corp. I know there's rollover benefits, but are you referencing in connection with the tax changes, or just under current law?
Just sort of in current law, I think was the question.
Okay.
So with current law, I mean, you can essentially swap the stock for cash. You have a certain amount. I haven't done much work with ESOPs, but you have a period of time to deploy that into other marketable securities.
Yeah,
and then that essentially gets you deferral, because then I can sell off those other securities over time, and when I do that, I'm triggering the gain. I haven't done as much of that over the years, but it in the right circumstances, it can really be powerful in terms of getting out of the position, the closely held company, and really diversifying, and deferring gain.
Okay. And then you were talking, Irene, about various trusts, but with a generation skipping trust, if you sell a company that's held by one of those, don't the proceeds have to stay in that trust to be invested in other assets? Yes.
Yeah. So that, when I was talking earlier about making sure, you don't have any shifts in values, that's what I mentioned. If the trust owns 50%, or let's say the trust owns 100%, you may be paying the income tax, the capital gains tax on that sale but the proceeds all stay in the trust. So to Claudia's point earlier about making sure you have the money to pay the tax, if the trust own 100% of the business interest, then you definitely need to consider that, because if it stays a defective grantor trust as of the date of the sale, then you need to have a liquidity, or you need to turn off the grantor power that we.
One last point, David. I think it's always important to even, when you model out economics, you really got to model out the tax cash flow. How much is it? Where is it coming from? What's the source? Because, wealthy families, there's money in trust, in partnerships, and who's paying the tax on it. It's important to work through those issues.
Okay. So we've got just a minute to go. Key takeaway from each of you?
Sure.
Irene?
Okay. I would say my key takeaway is not to wait till November, December to do estate planning, because it seemed like there's some people who did that last year, and, it was a crazy end of last year. I have a feeling this year might be the same, depending on how this bill goes, but, you just don't want to wait that long. It's not the kind of thing that you can just flip a switch and everything, these trusts, these terms, you need to give some thought to that. So I start thinking about it now and not expect to wait till last minute to get that done.
Okay.
And for me, I would say, there's big changes on the horizon in terms of, ordinary rates and capital gains. Consider, maybe acting sooner rather than later. If you have capital transactions coming up, take them now and don't wait.
Terrific. Well, thank you both, Irene and Claudia. This was really in-depth and very, very interesting. I want to thank you for sharing your expertise with our audience. And audience members, thank you for being along with us today. Again, I hope that you and your families have a wonderful summer. And with that, I'm going to end the webcast. Thank you, Irene. Thank you.